Hello, my name is Ellen Seidman, and I'd like to welcome you to today's event, What's Next for the CRA? Thank you for joining our webcast. Again, my name is Ellen Seidman. I'm a non-resident fellow here at the Urban Institute. Today's webcast focuses on the proposed regulation issued by the Office of the Comptroller of the Currency, the OCC, and the Federal Deposit Insurance Corporation, the FDIC, that would change how banks are evaluated under the Community Reinvestment Act. During the webcast, we will discuss the potential impact on communities and banks, as well as look at procedural concerns about the proposal. Our format will be a series of questions for the panelists, some directed to one or two, some to all, and that will happen for about 50 minutes. We will then transition over to a Q&A session for the audience for the last 20 minutes. So let's welcome our panelists. First, my colleague, Lori Goodman, Vice President and Co-Director of the Housing Finance Policy Center here at Urban. Buzz Roberts, President and CEO of the National Association of Affordable Housing Lenders. Krista Shonk, Vice President, Regulatory Compliance Policy, American Bankers Association. Josh Silver, Senior Advisor, National Community Investment Coalition. And Mark Willis, Senior Policy Fellow at New York University's Furman Center. You can find out more information about them on Urban's events page, www.urban.org/events. So a few housekeeping items. This webinar is being recorded, and the recording will be posted online after the webinar. All the non-panelists are muted. Guests are welcome to type questions or comments in the Q&A box at any time, and we will answer them at the end if possible. Please include your name and affiliation, and if you want to direct a question to a specific panelist, please say so. So let's get started with some background. The Community Reinvestment Act, or CRA, requires banks to help meet the credit needs of the communities in which they do business, including low and moderate income neighborhoods. Passed in 1977, CRA has become central to the financial health and economic development of low and moderate income people and communities. The current regulatory structure was largely set up in 1995 before the rise of nationwide banking, internet and mobile banking, and before significant consolidation in the industry. And over the last 25 years, in light of these changes, as well as changes in community finance, there have been complaints about the lack of certainty in knowing what counts, the existence of CRA deserts and CRA hotspots, and the application of CRA to branchless banking. All of these have led to multiple attempts to revise the regulations. In December 2019, the OCC and the FDIC jointly issued a proposal to do just that. The Federal Reserve, for reasons Fed Governor Lael Brainerd outlined in a January speech here at Urban, did not join. The proposal would substantially change the current regulatory structure, substituting a balance sheet ratio for the current focus on loan originations, instituting pass-fail tests for retail activities and community development rather than today's more qualitative and graduated grading, and reducing the relevance of community needs to CRA evaluations. The proposal would thus change many interrelated parts of the regulatory system all at once. So with that background, let's turn to our distinguished panelists. First, now that you've had a chance to thoroughly digest the proposal and write your comment letter, and each of our panelists wrote an erudite and informative comment letter, what do you think are the most positive elements of the proposal? And what are the elements that give you the most concern? We've got 3 minutes each. Lori, let's start with you.
So thank you very much, Ellen. The most positive elements are threefold. First, they tackled the modernization issue. The world has changed a lot since the current version of CRA was adopted in 1995, 25 years ago. including the rise of internet banking, for whom the current concept of assessment areas certainly merits a reevaluation. The OCC and FDIC deserve kudos for starting this discussion on how it should be done. We also like the fact that banks are able to confirm in advance that an activity will count for CRA purposes before committing to a loan or investment. This is not the case in the present system, where the bank does not know in advance, and there are differences from regulator to regulator within each of the agencies. The not knowing what counts and what does not arises most commonly with respect to community development loans and investments. And finally, by giving banks more objective measures, the substantial time lag between examination and report issuance would be substantially reduced. However, the negative elements are quite negative and definitely would require a reproposal. Generally, before a proposal is adopted, the implications of that proposal are understood. This proposal includes no data that would help the public understand the likely impact of the proposal on either bank's performance or the impact on the communities of which they are a part. It's unclear how the regulators could have analyzed this carefully, as almost concurrently with the release of the NPR, the OCC made the request for a public input for much of the data that should have been included in the NPR. It's unclear how the metrics in the proposal were calibrated. We strongly believe that this rule should be reproposed after the impact analysis has been completed, and the analysis should be made available to the public so they can meaningfully comment. Second issue, minimal public disclosure. This NPR would substantially reduce the amount of information made available to the public. That is, the information for individual banks would be aggregated nationally, and the information for counties would contain no bank level information. The result, it will be impossible to assess how well an individual bank is doing in meeting community needs. Finally, the overall metric is based on balance sheet holdings. It should be based on extension of credit. In the mortgage and consumer lending categories, the loans are often sold into securitizations. These extensions of credit are important, but they're only counted at 25% of their value. By contrast, a balance sheet loan is counted up at 100% for the entire time on balance sheet. As we're seeking to modernize CRA, it's important to allow for and fully count loans that go into securities, as it's often the channel with the widest credit box. And one of the goals of CRA is to expand credit availability. Thanks very much.
Thanks so much, Lori. Buzz? Yeah. Okay, now you're on.
Sorry about that. Thanks for including us in this webinar and for putting it together. I agree, the good news really is the clarification of what activities are eligible, especially in the community development space. That's been an enormous source of confusion for banks and their partners. Resolving that, I think, will be extremely helpful. I would also say that we don't necessarily agree with all of the eligibility qualifications that the agencies have presented, but at least it puts them on the table for debate. The downside is largely in the new metrics, the primary measure called the CRA evaluation measure. So some truth in advertising on the description that the agencies have used. And what it would do is measure the total volume of CRA qualified activity on a bank's balance sheet. And then divide that by a measure of the bank's size. And as proposed, it's really most domestic deposits for banks. And the problems are manifold. First is that the same size, the same measure won't fit all banks, it won't fit all communities, and it won't fit all economic conditions. we see right now, economic conditions are changing dramatically because of the pandemic crisis, and banks would be expected to do just as much when the economy is in deep recession as when it's in rapid expansion. That's just not going to work. It also focuses on balance sheet. That is to say, what assets does a bank hold rather than the loans and investments the bank is actually making. I think that misses the mark. Lori already mentioned the implications for the secondary market sales. That's really a good example, but I would say that the penalty for selling loans into the secondary market is even worse than might appear. Although a bank would get credit for selling a loan into the secondary market as if it held it for 90 days, if the average holding period for a home mortgage would be 7 or 8 years, you can see really that a bank would get 7 or 8 years credit versus 3 months credit. So such a steep discount, almost to the vanishing point.
Thanks,
And that
Buzz.
just doesn't make sense. It also devalues impact on communities. There's no reason for banks to do hard stuff if they can meet their CRA obligations with the easy stuff.
Great. I think we'll go into all of those in greater detail as we go on. Krista?
Good morning, everyone. I would just preface my comments with a thank you to the regulatory agencies for at least putting the proposal together. We've talked about CRA modernization for a number of years now, and oftentimes taking the pen and actually putting ideas on paper is the hardest part. So hats off to the agencies for actually moving the ball forward on this. In terms of the positive elements, I would echo Laurie's comments in terms of predictability and consistency. We believe that it's very beneficial to banks to be able to have a list of qualifying activities and to be able to engage in a pre-clearance process, and we can get into that, the details of those a little later. The other thing I think that the proposal would lend, particularly when it comes to the qualifying activities and the pre-clearance process, is consistency. We've heard from a number of banks who, multiple banks will be operating in the same area, and Bank A will receive CRA credit for an activity and Bank B will not. Or there may be situations where a bank received positive CRA consideration on a previous exam for a particular activity, but maybe this time around it doesn't. And so those problems need to be addressed, and we think that the proposal can go a long way to addressing those situations. In terms of concerns, we would echo the comments that were made earlier regarding the balance sheet approach, so I won't reiterate those, but I think it's important to point out the interconnected nature of this proposal. I tend to think of it like a Rubik's Cube, the toy where you have all the stickers on one side and you need to try to align them, and just when you get one side of the Rubik's Cube solved, you realize that everything else you just did has been undone, and it's very interconnected. And the various aspects, just like the Rubik's Cube, various aspects of the rules don't operate independently. And one weakness we see in the proposal is really a lack of explanation in terms of how those different aspects of the proposal would impact each other. So when you start thinking or making adjustments to how you calculate the CRA performance benchmarks, and what you use as the sort of the basis for that. If it's retail domestic deposits, when you start adjusting that, it impacts what the benchmarks would be, for example. And when you start changing assessment areas, that has implications as well. So this is significant change, and we just don't think that there has been a really thorough understanding of how those changes would impact each other down the line. And that's one of the reasons that we've suggested that the agencies maybe take their foot off the gas a little, not abandon the modernization effort, but do a pilot program and test out some of these ideas on specific banks and see how see what the results will look like, and publish a report on it so we can all take a look and see what those implications would be.
Thanks, Krista. Josh?
Hi, good morning. I am honored to be on the panel and thank the Urban Institute for the opportunity. Here are the positive aspects of the proposal. It recognizes the need to update assessment areas on exams and the need to collect community development finance data. However, the proposal proceeds to botch both of these positive elements. Our greatest concerns have to do with the potential of this proposal to harm communities through less lending and investing, and to transform them into places less hospitable for low and moderate income people. Let me turn to my hometown of Washington, D.C. I am a huge Nationals fan, and I will now explain how this is relevant to CRA. While the World Series win is perhaps a once-in-a-lifetime event, more important is how the team can and should integrate itself into the community. An example now is Jose Andres using the stadium to prepare food for delivery to neighborhoods during the pandemic. Under the proposal, however, the predominant measure, the ratio of CRA activities divided by deposits, will drive banks to seek the largest deals. They will be tempted to gravitate towards stadium financing, whether it is the Nationals or the relocation of Dan Snyder's football team with its racist name. The community development activities around the stadium would be neglected. Close to National Stadium is public housing and housing rehabilitated by MANA, a local nonprofit, to provide homeownership for modest income, largely African-American families. But under the proposal, home lending in low and moderate income tracts would not be counted towards a bank's CRA performance. So we may get bank financing for stadiums, but no more housing for long-term residents who now may have to move after the gentrification in neighborhoods near the stadium and can no longer access jobs created by the Nationals. To make it worse, the agencies propose to allow essential infrastructure to count on CRA exams. Financing rehabilitation of the American Legion Bridge connecting Maryland and Virginia interstate highways may count. These projects could displace low and moderate income residents. In the 1960s, the power elite proposed a bridge called the Three Sisters Bridge, connecting downtown DC to segregated suburbs, and which would have destroyed many inner city minority neighborhoods. Do we want CRA to finance the destruction of neighborhoods and exacerbate inequality? This would be the proposal at its worst. At its best, the emphasis on big deals would result in chump change for modest income neighborhoods. We all need a fair chance, whether it was my Jewish grandparents as small business owners in the 1940s in New York City, or whether it is today's immigrant businesses. CRA is a law designed to combat redlining and empower communities by requiring banks and regulators to listen to the communities as they articulate their credit needs. This proposal would interrupt the central working of CRA by curtailing the role of community voice. Thank you.
Thanks, Josh. And Mark, can you bring us home here?
I could try. Thank you, Ellen, and thank you, Urban, for doing this. I think this is an incredibly important topic, and it's in danger of being lost amongst all the great tragedies that are happening as a result of the pandemic. So, you know, I'm fortunate to have worked in a number of different sides of the CRA, but it won't surprise people as having been the author. I'll do a little promotion here. So it's The Rating Stupid, a banker's perspective on the CRA, that I see it or think most about it from the banker's perspective. Now, I haven't been a banker for 10 years, but I've given a lot of thought about how the incentives here might work. So what's really positive is the effort for more certainty, more transparency, to some degree, more consistency, which others have pointed out. I think that's great. And an important tool of that is the pre-approval process. I wouldn't want that to be underestimated as to its value. But the concerns here are pretty fundamental from my point of view. So I'm trying to think about what is the incentive now? How will bankers think about CRA? So basically the proposed regs don't give any or much, maybe any, value to the impact on the community. That's part of, I think, what you've heard already. It's just a number. It's a dollar. Everything's translated into dollars. And I think the impact of that is that bankers will try and figure out, now there's more things that qualify, they'll figure out the best way to get to the right number. And as a result of that, I'm concerned that all of bankers will turn to their mainstream areas to carry this out, which traditionally is something we all want to see to get to scale. But there'll be no, as Ellen Simon has pointed out to me in the past, there'll be no thumb on the scale. There'll be no need for those mainstream businesses to pay particular attention to making a difference in LMI communities. And without that, I think also the specialized staff that many banks have to understand the risks in low and moderate income communities, they're not higher, but they may require more work. The loans may be smaller, but it requires some specialized knowledge. And that may be lost as the banks focus more and more on making the numbers rather than what the impact will be. So I'm sure we'll talk a lot more about that as we move into the specific questions. Thank you, Ellen.
Thanks. That's all really helpful from all of you. We're going to go into some specific elements here, picking up on some of what each of our panelists has talked about. Lori, let's start with you. The proposal's preamble, as you've noted, is notably missing in data about potential impact. And you and our colleague Jun Zhu did a huge amount of work using publicly available data to attempt to assess some of the impact. What did you find?
Well, thank you very much for the question. My answer to this is probably going to be slightly longer than my allotted 3 minutes, but I promise I will not exceed on any other question. Because this was really important because we probably spent what seemed like just thousands of hours trying to understand the impact of this proposal. We recreated all the variables we could. In many cases, we were conservative because we didn't have data that would reflect the expanded definition of community development loans that Josh mentioned, or the increased dollar cutoffs for small business and small loans. So for small business loans, we used $1 million maximum threshold. Under the NPR, the limit is $2 million. We understated community development investments and consumer lending due to a lack of data and didn't count community development services at all. We also did not give banks any credit for the share of branches in LMI areas. But our bottom line was, even with our conservative assumptions, we have incredible grade inflation. We find that an astounding 84% of the institutions received outstanding ratings and 1% are satisfactory. This compares with existing ratings of 10% outstanding and 82 satisfactory. The CRA evaluation under this NPR is reasonably complex. There are actually 3 separate tests: an overall metric, which tallies CRA qualifying activities across the retail lending categories plus community development activities and compares this relative to retail deposits. If the overall metric is greater than 11%, the presumptive rating is outstanding. If greater than 6%, the presumptive rating is satisfactory. For the overall metric, we find that 95% of the banks met the 11% overall metric for an outstanding rating, and another 2.7% met the 6% requirement for a satisfactory rating. This presumptive rating can be achieved by passing two pass-fail components. Community development loans, investments, and services must comprise at least 2% of retail deposits in at least 50% of the assessment areas. For the CD pass, we were unable to do any analytics at the assessment area level, but we found that 92.2% passed overall. But again, our assumptions were very conservative because we were unable to consider the expanded definition of community development loans, as the data simply doesn't exist. A particular problem we didn't focus on was the retail lending part of this. The retail lending tests are each pass-fail. A bank is subject to the retail lending test for each retail category that comprises at least 15% of bank level dollar volume of total retail originations during the examination period. So there's a borrower distribution test for mortgage and consumer loans, Small business and small farm loans. There's a geographic test for small business and small farm loans. In other words, 6 different distribution tests. Each of these tests is applied to the assessment area, at the assessment area level, and is based on the number of loans originated. Each of these tests in turn has 2 components, and the bank must pass one in each assessment area: a demographic comparator with a 55% threshold and a peer comparator with a 65% threshold. To be able to get a presumptive rating of satisfactory or outstanding, the bank must pass each retail lending test to which it is subject in 50% of its assessment areas. So for the retail lending tests, we didn't have the information to perform tests for consumer lending at all. We were unable to perform the demographic comparator tests at all. We were able to do the peer comparator tests for 5 groups: borrower distribution for mortgage lending, and the borrower and geographic distribution tests for small business and small farm lending. We required 20 loans in 2018 to be subject to the test or to be a part of the peer group, higher than the 20 loans over the examination period of 3 to 5 years that's required in the NPR. We found that while banks failed in many of their assessment areas, 100% of the banks with over 10 billion in assets were able to meet the 50% assessment area pass rate easily. While most of the smaller banks passed, not all did. The test most likely to be flunked was the small farm geographic test, which proved particularly difficult for some of the smaller banks that had 2 to 3 assessment areas. And this pass-fail retail lending test is unforgiving. If you flunk one test, you flunk the entire exam. There's absolutely no notion of compensating factors. So, bottom line, 84% of the institutions receive outstanding ratings, 1% are satisfactory, the balance flunk, usually because of flunking one of these retail lending tests that's totally unforgiving. Thank you.
Well, I think Krista's Rubik's Cube analogy becomes extremely clear.
That was a great analogy.
Yes. Thanks so much, Lori. Josh, maybe fairly briefly, you did a lot of numerical analysis also in very different ways than Lori did. Did you come to approximately similar conclusions?
Yeah, basically when you have 2 reputable organizations kicking the tires and kind of differently and coming to similar conclusions, I think there's an issue here. First of all, I want to thank my colleagues Jason Richardson and Bruce Mitchell for their excellent hard work with the data crunching. In the first analysis, we used call report data to calculate the percent of deposits that would need to be devoted to retail lending in order for a bank to receive a satisfactory and outstanding rating. This was the numerator. We then had call report data on retail lending, which formed the denominator. The result of this ratio revealed that banks could devote lower percentages of lending to low and moderate income borrowers and communities than they do currently and pass the CRA evaluation measure. To give you a sense of this, banks issued about 24% of their small business loans in low and moderate income census tracts measured by dollars. The ratio banks could lend and earn at outstanding under the proposed ratio measure was about 16% and 8%, 16% for outstanding. In the second analysis, we used the new Federal Reserve data on CRA, which was released just a couple of weeks before the end of the comment period. It was based on an example of 6,300 exams. We calculated the CRA evaluation measures as closely as we could to the proposed rule. The Fed data didn't have all the data points we needed, but we did the best we could. We generally found that the banks were above the outstanding level on an assessment area level. The Fed data was on an assessment area level. For example, regional banks hit a ratio of 13.4% on an assessment area level. And remember, 11% was needed for outstanding. In the third analysis, we looked at 3 large credit card banks. The results were basically the same. They were at or they exceeded their CRA evaluation measure. This mandate of CRA requires banks to continually and affirmatively meet credit needs. That suggests improving performance over time. It does not suggest stagnating performance are actually decreasing your lending and investing, which I think because they went with numerical targets in the run ratio measure, these targets tend to be conservative. And we think we get stagnating and decreasing CRA performance over time, and performance that distorted towards things like the American Legion Bridge. Thank you.
Ellen,
Thanks. I was going to ask whether any of the other panelists want to jump in here.
Yeah,
Mark?
I just want to, there's a danger here from this conversation in that it's the thresholds that matter. So you could raise those thresholds all you want to, and it wouldn't necessarily get the results. There's, again, no measurement of impact here. And, you know, I just want to make sure that people don't think, well, oh, I just heard them. If we just raise those thresholds a little bit, it'll all work. No, there's a basic fundamental problem about pass-fail, as Lori pointed out, in that it's so absolute. And there is this whole question of, can banks meet whatever threshold you give without actually having any impact on their communities?
Krista or Buzz, do you have comments? Okay, let's go on. Go ahead, Krista.
Oh, this is Krista. I was just going to say that we concur with Lori's observation regarding the pass-fail nature of this with respect to the retail lending distribution test. And the other thing it doesn't really take into account adequately, in our view, is accommodation lending that banks undertake. And one of our concerns with the proposal, I guess more broadly, is there really isn't a lot of recognition of different types of business models reflected throughout the proposal. And this issue on the retail lending distribution test and accommodation lending and the pass-fail nature of that test is one of those ways in which it comes to bear.
Interesting. Good point. I think a lot of us sort of missed the pass-fail problem when we first looked at the proposal, but it's been interesting as folks have dug into it. Let's go to the piece of the proposal that I think all of you have suggested is one of the positives. And that's certainly the part relating to what counts that allows a binding opinion before anybody makes an investment, but also to some extent the expansion. And the way I looked at this is that that many of the items that have been added to the list of things that count might be perfectly fine in context when they actually meet community needs, but sort of the way it's been done takes that context away. So I would be really interested in first, Krista, your thoughts about how important these changes are and what do you think their effect will be, and including on the willingness of banks to make unusual or out-of-the-box investments, which is stated in the preamble as one of the goals. Mm-hmm. Krista?
Yeah, right. So, you know, one of the goals of CRA, as Mark has been pointing out through our discussion, and rightly so, is to encourage banks to be responsive to the needs of their communities. And, you know, we have heard from our member banks that they are not oftentimes willing to take the risk that an innovative or responsive activity might not count, and that they won't find out until exam time. And so as a result, banks are today incentivized to stay with the tried and true activities that they know will receive credit. And so we think that a pre-approval process could really help spur types of new types of innovative and responsive CRA activities. The key to that, however, is that that process has to be timely in order to be successful. Under the proposal, I think there was a 6-month response period, and our members told us when we were talking through the proposed rule that 6 months is just, it would not provide value to them if the agencies could take that long to give the bank a response. And so we actually recommended a response or a turn time of 30 days. And the reason for that is we understand that particularly in the community development context, these deals and transactions can occur very quickly, and the opportunity may be there one day and gone the next, so to speak. So in order for that pre-clearance or pre-approval process to work well and to accomplish its objective of encouraging innovative and responsive activities, it really does, we need to make sure that it's timely. The other thing,
Go ahead.
I was going to say, the other thing I would mention, we've talked a little bit about on the call today, and has really been a thread throughout the course of the modernization conversation, is the focus of CRA on low and moderate income individuals, and rightly so. But I think one really important thing that has come out of the discussion on modernization over the past couple of years is the recognition that communities in our country are different. People order their lives in different ways. If you're living in a small town or a rural area, and we've heard that in some areas it's been very difficult for our member banks to obtain CRA credit. And it's really, I think it's important to point out that rural does not always equal low income. Oftentimes it's middle income. And so we've been very supportive of this idea of assigning pro rata credit based on LMI benefit. And we think that that's one very positive aspect of the proposed rule. Again, the devil will kind of be in the details there, but one thing that will be critical to making that work if the agencies choose to finalize it will be making sure that we have consistent criteria or guidance on how to document that LMI benefit.
Thanks. So I know, Josh, you're going to want to talk about this, but Buzz, if you would talk a little bit about specifically how all this affects affordable housing. Why don't we do that first, and then we'll go back to Josh.
Thanks. Affordable housing is a mixed bag, I would say, under this proposal. The good news is that there's a lot more clarity about the treatment of affordable housing that doesn't get government subsidy. So 80% of the affordable housing, rental housing in the US does not receive subsidy, and CRA in the past has been very unclear about whether and how that counts under CRA. That's had a chilling effect. So that's a good step forward. A challenge here, though, is for more complicated development projects involving affordable housing. And there, the question is, will banks have so many other easier opportunities to achieve their CRA objectives that they don't need to get involved in the more complicated development deals? Also, while we're on affordable housing, it's useful to note that one of the first reasons for creating CRA back in 1977 was to encourage banks to make home mortgage loans in low and moderate income neighborhoods. That is no longer an explicit focus under CRA going forward. So there's a real abandonment of that initial purpose, which I think most people would say is still relevant today. There are also some things that are missing from the eligible activities that are notable. For example, financing a grocery store in a low-income neighborhood no longer counts as CRA qualified because the agencies have removed the concept of neighborhood stabilization and revitalization. And many economic development activities that create or preserve jobs would no longer qualify where they did before. And again, that's just missing a really important need for a low-income community.
Great. So Josh, if you could be brief, because I know you have a lot to say on this topic, but we did get a question coming in about your remark that Buzz has actually just also amplified about housing in low and moderate income communities not counting. And it's the issue of community versus people. Can you make sure that you cover that as you're talking about this?
Sure, real brief on you answer that question. It's just what they propose. On the lending test right now, there is an examination of lending to low and moderate income borrowers, and there's an examination in low and moderate income tracts. And I think, Alan, in the future question, you're going to ask us a little bit, you can ask me a little bit about redlining. So I'm going to save
Why
some
don't
of
you
this.
answer that now? Because I was actually going to not ask you that question.
Aha. Okay, wow, you asked me to be brief and then you give me another question. So anyway, again, Buzz is exactly right. This is why CRA was established, to combat redlining, which was a neighborhood-based phenomena. And the agencies are proposing to eliminate the criteria of lending in low and moderate income tracts because they're concerned about gentrification and the loans just going to middle and upper income people. Well, most of the low and moderate income tracts across the country are economically distressed. So you are trying to combat a problem with, shooting a nuclear bomb at it, which is going to devastate most communities. Instead, you can use their academics and also one of the researchers at NCRC can identify tracts that are actually undergoing gentrification through increases in housing prices and other metrics. And then you can decide in those tracts, okay, we won't count lending to middle and upper income people. There's a more surgical and effective way to deal with this. Now, real quick, I agree with Krista that pre-clearance, will this count on my exam, is very important because it will facilitate bank and community partnerships on innovative and complex projects. But I do part company with some of the bank trade associations about broadening credit beyond low and moderate income people. Let's take the example of financial education. Under the proposal, financial education for the Comptroller currency would count because there will be no income restrictions. And think about redlining and discrimination disproportionately. It impacted low and moderate income people. If you now say CRA is going to solve everyone's problems, it will solve no one's problems. And the initial people that it was supposed to help solve were, problems and discrimination encountered by low and moderate income people. On the small business side, raising the revenue size of a small business that would count on a CRA exam alone to a small business from $1 million in revenues in small businesses to $2 million. Well, the Consumer Financial Protection Bureau says 95% of the small businesses in the country have revenues of $1 million or less. So what are you going to do? You're diverting lending to businesses that are really beyond the barber shops or the landscapers that are particularly suffering right now under the pandemic. Finally, revenues up to $10 million would count in the case of family farms. 75% of farms have annual revenues less than $50,000. Again, if the OCC had asked the U.S. Department of Agriculture, it would have known that we probably shouldn't have raised the revenue qualification to $10 million for family farms.
Thanks a lot. Lori or Mark, do you want to jump in on this question? Mark, I'm going to go to you next on the issue of CRA deserts. So, Mike, just.
Right. I'll just be very, very brief here. This whole NPR expands what qualifies. As I said, eliminates the LMI test and switches to the balance sheet, which actually can result in banks not having to originate any loans from one exam to the next. It's I think the danger from my perspective, looking at how bankers will see, they're going to see that they can meet the thresholds with their mainstream businesses. They don't need specialized staff to do that. And if that's the lesson they learn from this, over time, we'll see these very highly talented, very special staffs that exist in a number of banks. We could easily see that attrit away. And I think that would be a great loss to trying to bring more value and more equality and inclusion to low and moderate income communities. Something that, by the way, COVID has really pointed out as being very important now.
Okay. Lori?
I find the expansion of activities, particularly on the community development loans and investments, particularly frightening. But I think Josh has already done such a good job of covering that I'm gonna waive my time.
Thanks. Okay, so asking 4 Washingtonians and 1 New Yorker about CRA deserts is probably not the best panel, but we'll try anyway. Mark, I know you've been really very concerned about this issue of limited scope exams and other kinds of things that disadvantage in particular rural areas. Does this proposal solve that problem? Mike?
Yeah, right. Sorry. Again, it's very troubling here. There is talk about dealing with hotspots. There's talk about helping credit or CRA deserts. But there's nothing in substance that deals with those. If anything, the deposit-based facility measure for internet banks, where banks get 5% or more of their deposits, just takes it to New York, takes it to LA, more and more of the CRA effort. It doesn't, it allows you to get credit elsewhere, but again, why do that when the focus is on these large cities? So I'm very concerned that you're going to get the opposite. Hotspots. New York is a hotspot in some ways, and it's likely to get even more CRA attention here. So. The whole issue of what to do with internet banking, where there are internet banks that basically have a home office one place and there's an assessment area there, or large banks that have a significant internet presence. There's really no measure, no benchmark for determining what they are doing on the retail side outside of their assessment areas. And to me, that makes no sense.
So Krista, you've got a lot of small institutions that are part of the ABA, a lot of rural institutions. What are your thoughts? What are your thoughts on this whole issue of whether this proposal does something about the CRA desert problem?
Yeah, well, it's funny you talk about us being Washingtonians and maybe not being the best, barometer for addressing CRA deserts, but many of us are transplants and came from areas that were CRA deserts. So I guess we have that expertise or experience we can draw from. But in addition to that, our members concur with this concern that the deposit-based assessment area concept would focus activities in population centers and really wouldn't address the desert problem in a couple of ways. First, to state the obvious, banks just don't have large concentrations of deposits in areas that would benefit from additional CRA loans and investments. And one thing the proposal really didn't address was how banks would have an incentive to actually go into those deserts or those areas and provide the loans and investments and economic boost that many of these areas need. So, we share the concern. I'm not sure that we know really what the right answer is here, but we do think that some sort of incentive would be in order.
Hi, Ellen.
Go ahead, Josh.
If I could, real quick, on the assessment area, boy, they recognized it was a problem. And this is something that advocates have been talking about for years and banks have been talking about for a long time, but they completely botched the solution. Using deposit data outside of where banks have branches, banks don't collect that data presently. So you can't even evaluate the effectiveness of their proposal. It was interesting, Krista, that I think it was the Independent Community Bankers Association that said, use loan data for designating areas outside of branches for additional assessment areas. And in fact, if the agencies had just looked at their own CRA exams, there are exams of non-traditional banks right now that use that approach. There's a bank called Bank of the Internet, talking about internet banks. And physical areas, states, and metropolitan areas were designated as assessment areas outside of the headquarters of the internet bank. So they used the existing lending data to designate out additional assessment areas. And then the issue of hotspots and deserts. Why don't you use data and calculate counties in terms of low levels of loans per capita? You can start with retail lending, and then hopefully we get a community development database as well. So you could designate the counties in the country that in the lowest quintile, the counties in the lowest 20% of counties that receive the lowest amount of loans per capita, those would be underserved counties. So if you want to give people incentives to serve areas that are deserts, explicitly identify the deserts and then say, if you want to go outside of your assessment areas, serve these areas first. I would actually keep the states and regional areas that right now are on CRA exams. For, if you satisfy the needs in your assessment area, you can go to states and regional areas. But then I would also add underserved counties. And then hopefully over time, some of the underserved counties would fall off because they're being served. And then other underserved counties would emerge. So it would be a dynamic approach using real-time data that hopefully would even out and eliminate some of the deserts over time.
Anyone else want to talk about this thought? Because I'm about to move on to the public disclosure issues.
I will weigh
Buzz,
in briefly
Buzz,
on it.
go ahead.
So the good news is that when the banks are evaluated at the entire bank level as opposed to at the local level, they get to count activities anywhere in the country. And so that would include rural areas that are outside their local target areas. The problem is loans in rural areas tend to be small. And so the overall CRA evaluation measure is going to devalue those. And community development deals in rural areas tend to be especially complicated. And again, there's very little attention to that complexity. So a bank's route to achieving its outstanding or satisfactory rating.
Buzz, let me just say that your internet is sketchy. I don't know if there's anything you can do about it, but just fair warning, we're having a little trouble. Anyone else on the assessment areas issue? Okay, I'm going to go on to, because we're, particularly if we start getting a lot of questions, we're getting close on time. So one of the aspects of the proposal that's actually gotten surprisingly little attention is the revision of the public disclosure regime. And as Lori and I read it, it essentially eliminates any geographic disclosure of the activities of individual banks and, in fact, aggregates information about the activities of all banks at the county level. And in some places, counties are small, but I remind you that Los Angeles County, which includes more than Los Angeles City, is a county, and Cook County, which includes more than Chicago, is a county. And at the same time, the CFPB is cutting back on HMDA reporting and disclosure. Lori, as a user of public data to do evidence-based policy analysis, what do you think the impact on the public's and policymakers' ability to understand how banks are doing in their communities? What will this impact be?
Yeah, so basically it's going to be impossible to see how an individual bank is doing in any given community. The information that's going to be released is going to fall into two buckets. First, for each bank on a nationwide basis, you're going to get the value of qualifying retail loans, community development loans, community development investments, and community development services. So just nationwide numbers. And then for each county, we're going to receive aggregated data for all banks in the county. So we're not going to know how a given bank is doing in terms of mortgage lending, to Cook County. We certainly going to have no idea what banks are serving the Gold Coast in Chicago versus the poorer west and south sides of the city, or which banks are serving the Upper West Side of Manhattan and who's lending in East Harlem. We're going to have no individual bank information at the community level at all, or even at the county level, which is just devastating to doing any type of research in this area.
Sorry. Krista, much of the ABA's comment letter was about the difficulties the proposal would pose for data collection and retention and all of those issues. But I had actually a hard time as I read the letter trying to understand what your position is on the public disclosure issue. Could you talk a little bit about that?
Mm-hmm. Let's maybe tie this into part of the earlier discussion that we had earlier today on the balance sheet approach. I think that the agencies proposed the balance sheet approach because they thought it would be streamlined and it would be simple. But not surprisingly, we have significant concerns just about the level of complexity that would be associated with that and the cost, not just initially, but on an ongoing basis, because funneling everything through to a balance sheet would require plumbing multiple systems together, would require data generation on a monthly basis and capturing that, putting the proper controls in place and so on. And so, particularly when it comes to mortgages, we suggested that the agencies not adopt the balance sheet approach, but instead use HMDA, and HMDA reporters could utilize the LAR, and then non-HMDA reporting banks could use their existing systems. So, I think it's important that we not recreate the wheel as it relates to data, and it would be, it would address the really the data burden on banks and allow them to leverage their existing reporting structures.
Thanks. Josh and Mark, both of you do a lot of policy-based research. What are your thoughts on the disclosure regime?
Well, data is very important for community-based organizations. We have a saying at NCRC that data drives a movement for economic justice. In other words, you use data to identify which areas are receiving loans and which areas are not receiving loans on a neighborhood basis, because remember, that was the genesis of CRA. Neighborhoods were being redlined. And data also, it serves a very positive collaborative function because you can agree on a common set of facts. If you're using HMDA data that banks are submitting, you are identifying disparities based on income, by race, by gender, and then you might disagree about what is causing some of the disparities, but you identify the disparities, then you can sit down together, roll up your sleeves, develop partnerships, develop products that help address some of these disparities. And then when I read, the proposal is just not articulate. When I read about call report data possibly substituting for HMDA data, I'm still scratching my head. I don't know what that means, because there's no way in call report data to identify a loan to a low and moderate income borrower, at least not the present call report data. And Lori's exactly right. I won't repeat everything she said about county and bank-wide, because she is exactly right. How do you know what an individual bank today with HMDA data, you can know whether it is making a loan in a particular neighborhood. And by the way, the CFPB raising the loan threshold to 100 loans, that's too high. Some of those banks are very important. We found at NCRC the impact would be disproportionate in rural communities in terms of if you make 99 loans, you no longer have to report HMDA data. And then lastly, I'll just say this. We have no idea what data will be displayed on CRA exams. Now CRA exams have useful tables, at least on the assessment area level, how many loans, what percentage of loans are going for low and moderate income borrowers, for example, and the public can read those data, read that table and understand it. Is that presentation going away? And that would be a big loss, especially as we try to recover from this pandemic.
So, Alan, you asked about research. I'm actually not going to comment on that. Obviously, more data is better for research and really understanding what's going on unambiguously. The tension here really is between banks who worry about privacy. They're not always sure they're collaborating with their community groups. I always had a very successful time doing that, and data really is helpful there. But finding the right balance, I just find it incredible that we're backing away from even where we were before and providing less information, which will just make the tensions more difficult as to, and speculation really of what's going on there when the facts are known and could be helpful for that kind of collaboration, or even if the bank doesn't want to collaborate, the bank can at least understand better what it needs to do. So I think it's really important to have more transparency and more, honestly, public involvement, and you can't have that if the information is not there.
It's unfortunate that both the banks and the communities are going to be disappointed with this data question, because for banks, it's a dramatic increase in administrative burden. And for communities, it's a dramatic decrease in access to data.
Well put. I want to go on to a question that we've actually gotten a fair number of questions from the audience on. And by the way, there are apparently some lawyers in the audience. And we had discussed on our prep call whether we would go into the questions involved with the APA, the Administrative Procedures Act, and whether there's a lawsuit here and who has standing and is it right. We decided that we would not do that, so we're not going to answer any legal questions, even though there are a few lawyers in the group. But we are going to answer a really important question about split rulemaking. So over many years of CRA rulemaking, the regulators have worked together and they've issued virtually identical regs, and as well as Q&A interpretations. Now, this has taken a long time. It is a very messy process. But in this case, the Fed is notably missing from the proposal. And while both the OCC and the FDIC have said they would like to come together with the Fed, the Comptroller has also indicated a desire to move faster than that's likely to be the case. So starting with you, Krista, what do you think will be the implications of this split, especially if a rule goes final without the Fed? And what would happen if the FDIC also declined to join?
Yeah, well, let me just say that the importance of joint final rules really can't be overstated. Every day, banks who are regulated by different agencies partner together on CRA lending and investment activities, and consistent rules would go a long way to making sure that those types of partnerships and important activities will continue. I think by contrast, inconsistent rules would be a barrier to those relationships and the much needed infusions of capital that they provide to communities. So the importance of those partnerships and consistent rules is sort of point one. Then on point two, it's really important that a modernized CRA regulatory framework be long-lasting. As we've seen from this exercise as well as previous CRA updates, it's a Herculean task, and it occurs only every so many years. And it's really important that the regulatory changes have broad support and avoid the risk of being unwound either by future regulators or perhaps even by members of Congress. It's also important that rules be calibrated appropriately, so we get to the point where we don't have to have multiple rounds of amendments or adjustments or clarifications. And to the extent that we have either multiple regulators issuing multiple CRA regs, I think that it really takes away from the consistency and the clarity and predictability that really have driven this entire process. So, split rulemaking would certainly not be ideal.
So, Buzz, you also run a membership organization that has members who are regulated by different regulators, and my guess is multiple regulators. What are your thoughts on this?
So for an individual bank, it's not that complicated because there will be one set of rules that applies to them in most cases. There are exceptions, for example, for FDIC insured banks that are subject to state CRA requirements, and they could very well have two totally different exam regimes. But the real trouble here is for people in the community who are trying to borrow money from banks, get invested in banks, because it'll be extremely confusing for them to understand which regulator oversees which bank, and therefore which complicated set of CRA rules is going to drive the relationship that they have with that bank. And to try to fit all that together is going to be a lot harder. And there are two ends to any loan. There's the lender and there's the borrower. and CRA has to work for both.
Mark, Josh, Lori?
Yeah, I'd like to say something. I think that analogy on the user end of this, community organizations will be baffled if there's inconsistent rules. Why one bank is responsive to a request for a project and another bank is not. You know, community organizations are not familiar with the Byzantine world of bank regulatory agencies. And think about creating a small business incubator that is really financing micro businesses. Why are 3 banks participating and 2 of them have no interest whatsoever? Because the 2 of them might be able to finance the Jumbotron in Dan Snyder Stadium, but you know, the real hard work of you know, micro business finance, they don't care about. I think this would be, you know, extremely detrimental for communities. You need regulations that are uniformly rigorous, not porous and lenient.
So
I would
Mark,
just-
let me ask you,
Okay,
as
sure.
somebody who has worked for a big bank that went through multiple regulators, if I recall correctly.
Yes, right.
What does this do with respect to the regulatory arbitrage issue? To the problem that we already have with banks being able to sort of choose their own regulator?
Yeah, no, that's true. And I particularly think of it because Chase was a state bank at one point. And the state of New York has its own CRA regs. So they have brought them into conformity with the existing system. What will happen in the future? And so there will be, you know, should I be a state bank and a national bank, as you just said, arbitrage of that for lots of reasons. This would just add another layer of confusion and or motivation or whatever that is completely wasted energy, to say the least. I like to just add to Krista, I just underline something that she said. You want broad support. Why do you want broad support? Because you don't want them changed in a couple of years. The last thing bankers need is the rules to go back and forth every time you know, there's a change in Washington. That's just be crazy. And they also don't want, you know, a lot of different states might all of a sudden impose their own CRA kinds of regulations if they're not happy with what the federal is. I mean, one thing about the uniformity that CRA brought is there was a concern across the country about banks reinvesting in their communities. The federal government dealt with that. And so localities didn't, you know, there still is pressure today in some cities to have their own CRA. If this opens that up, it's even a bigger problem for bankers.
Interesting. Lori?
Let me just make one point, and that's, you know, I think basically it's sort of interesting that everyone on this panel comes from very different perspectives, and we're basically all saying exactly the same thing, which is that this set of rules should be reproposed. And, you know, I think, you know, Krista's, what the ABA's comment letter called durability is a huge reason for it. There's a lot of transactions costs in making a change in CRA. You want to do it once, you want to do it right, you want to do it with the proper analysis. You want to eliminate any sort of regulatory arbitrage. You want all 3 rating agencies, all three. We
know where you came from.
So, you know, I think we're basically all saying it really should be reproposed with all 3 regulators on board.
So let me turn now as a last question, but this is again one that we've been seeing some echoes in the Q&As. And this is the issue about the current pandemic. The Comptroller at one point invoked COVID-19 as a reason to move ahead with this proposal, whereas others, including several of you, have suggested that it's a reason to slow down. We've also gotten a question, and recent regulator guidance has actually invoked CRA in the context of banks working with their communities with respect to COVID. We've also gotten a question of from a reporter on, well, if what in this proposal would need to be changed to respond to the various issues that COVID-19 has made so clear. So let's end our formal part on that note. And who would like to start?
I would comment here that I think we've seen
I'll go
in
after Mark.
COVID place-based problems. That is, it's disclosed traditional underinvestment in public health, underemployment, security, all sorts of issues in the neighborhoods that now seem to be most impacted by the pandemic. And it suggests that we need to pay attention in those communities, and to take the thumb off the scale for that at this point in time seems inappropriate.
So
Even if it
the
ever does,
re-emphasis on place-based.
yes.
I would like to add, first of all, I started off my opening remarks talking about Jose Andres and the Washington Nationals basically running a food bank from the stadium. And the CRA guidance that was issued in middle March talked about loans, investments for providing food, addressing food deserts, for internet access, which is incredibly important right now, for healthcare facilities. If you're going to a proposal that features the CRA evaluation measure, that features large deals. And are you undercutting your effort? A small business owner that needs a loan for $50,000 to survive, will a bank have any interest in that? And it also talked about waiving fees, waiving overdraft fees, bank services. The proposal proposes to eliminate the service test, which measures these things. So in a sense, I was glad there was an interagency guidance. This proposal undercuts the interagency guidance. And lastly, I think Mr. Otting is wrong about the timing, because imagine gearing up for an overhaul of the proposal. It would take banks 1 or 2 years to revamp their data collection systems, for example. So hopefully, let's hope that this is over in a year or two. So, Mr. Otting is, even when this new thing would be implemented. So I think Mr. Otting is incorrect on that timing aspect as well.
Let me pick up on Josh's point. I mean, COVID-19 actually gives us a reason to slow down. Everyone's very distracted. No one's going to give this the proper amount of focus to redesign this proposal the way it should be designed. The banks don't have the bandwidth to implement. We haven't done a thorough review of CRA since 1995, and there's just no reason to rush it through now. The current system isn't perfect. I mean, it's certainly far from perfect, but it works reasonably well. We should take our time, gather the necessary information, do the proper analysis, understand the implications of the changes, and then re-propose the rule, gathering informed output from that re-proposal. In addition, it'd be great to have the Fed on board, and it's worth spending the extra time to do that. So there's just absolutely no reason to rush it in any case, and COVID-19 gives us even more reason to slow down.
I would just add a couple of points.
Just a second. Krista, are you on the phone even though we've lost your video?
Yes, my internet just dropped. So
Yeah,
I'm not
okay.
sure why my service is gone, but I'm here.
Okay, well, that makes it, as you know, that makes it even trickier with respect to moderating this panel. So you need to jump in, and since we're talking right now, I'm going to ask for you to talk next.
Okay.
This is on the COVID-19 issue.
Okay. Yeah, I mean, look, even under normal circumstances, implementing a modernized CRA framework would be a really heavy lift for banks. And, now that we're here during the pandemic, bankers are marshaling all their resources to help consumers and businesses and, just help them to deal with the significant economic impacts that we're seeing associated with our public health crisis. It's all hands on deck for PPP, mortgage forbearance. We're anticipating, forbearance repayment issues on the horizon. And, not surprisingly, we have started to see a number of questions from our banks with respect to how COVID response and CRA will intersect with each other. And we certainly hope that there will be a uniform regulatory approach to that. This just is not the time to have multiple or different regulatory regimes, both in terms of how regulators may interpret the COVID interpret the application of CRA to COVID today. And it's certainly not the time to have different regimes as it relates to modernization going forward.
You're on mute. Mute.
Oh.
Oops, go ahead, Mark. Do you
Yeah,
wanna jump in?
I just want to underline something that is implicit, and I always said it, and Lori made explicit in a statement here. The system is not broken. It is working. There are lots of things we, and everybody here may even disagree on something of how it can be improved, but we're not in a crisis that this thing has completely broken down. And it's even not clear to me that you really need to change it in such a dramatic way to address the internet, the clarity, and the other issues that this is supposed to be doing. I think it can be done within the current system in a much more moderate way. This is a very dramatic change for, creates all the problems we've talked about. And right now, we have a system that's working. Again, it can be improved, and we'd all agree it should be, but that doesn't mean we need to rush here.
Okay, I would like to go over to questions now, and we've been getting a lot of them. I don't think I need to remind you to put in questions because you are all putting in a lot of questions. So let me just cover a few that I think we haven't yet covered in the context of the discussion, because I've been watching the questions as they've been coming in, and we've tried to cover quite a few of them, particularly where they've converged. We've got a question which talks about Native communities and do they fall within assessment areas. We know that Indian country is definitely one of the CRA deserts that is specifically called out in the proposal and made eligible. Lori, I know you did a little bit of work on this in the context of your work. What did you find with respect to Native communities?
Yeah, so basically anything, any credit extensions to Native communities count whether or not it's LMI, whether or not it's to an LMI borrower. So it's a little bit of a boost. The numbers are fairly small, but it certainly helps. But then again, the numbers are fairly small.
So, and Lori, how did you define Indian country when you were doing your work? You've forgotten. Okay.
No. So basically, we did a we defined it properly. We actually had a geographic overlay for some very good work done by by our metropolitan, by another center at Urban, who had actually done a lot of work on Indian communities under a HUD grant, and they had basically given us a shapefile geographic overlay that we used on top of HMDA data. So we were able to do it very well for mortgages.
So Nikki Love, if you want to follow up with Lori, I'm sure she would be happy to talk to you more about that.
Yeah,
Real quick, Ellen, if I may. We actually did a little looking at the Native American reservations, and they are, by and large, they're low and moderate income. A lot of them are economically distressed. So actually, under NCRC's idea of identifying underserved counties and these places you can serve outside of your assessment area, it would help. Now, Mr. Otting has gone out of his way to say, my proposal will really help Native Americans because we're offering them special treatment and special consideration. But what I would say is, let's look at the big thrust of his proposal. Again, if you can finance essential infrastructure, the Dakota Access Pipeline, we've had conversations, would that count And Native American communities have been bitterly opposed to that because that threatens environmental destruction. So the overall thrust of the proposal, I don't think would be helpful and would actually divert a lot of community development financing from Native American proposals. Number one, you've got to respect Native American communities. I made a remark at the beginning about Mr. Snyder's, the racist name of his football team, and I'm very serious about that. We need to get rid of sports mascots that are stereotypes of Native Americans. We need to respect them, and we can't set up a CRA regime that provides credit for things like the Dakota Access Pipeline.
So, I mean, just to pick up one more point that sort of came up earlier, and that is that most of the loans to Native American communities tend to be very smaller loans. So while they count, and they are not, whether or not they're LMI, the numbers are so small, and the total boost is very, very small in the context of a metric that's totally volume based.
So Buzz, I have a question for you. It is specifically relating to why financing an inner city grocery store would no longer count. But I think this is an opportunity to also talk about the broader economic development and community revitalization issue.
Right. So under the current rules, activities that stabilize or revitalize a low and moderate income neighborhood count for CRA. And so financing a grocery store would certainly fit that requirement. But that category is now eliminated under the proposal. Instead, banks could get credit for making small loans to businesses, but if it's a grocery store, it may need a larger loan. And they get credit for even making large loans to small businesses. But if it's a grocery store that's not, doesn't meet the small business requirement because its revenues exceed $1 or $2 million, then it won't qualify there either. And this really gets back to the broader point that communities have different needs, and CRA is intended to encourage and reward banks that are to address those needs. And there's just a lot missing. Same on economic development activities, financing a business in a low and moderate income community that's generating jobs would only count if the business is very small. And much of the job creation is going to come from businesses that are just going to exceed the size threshold that are recognized under the new proposal.
So we have two quick rural questions that I'd like to deal with really quickly. There's also a question about, does the new proposal allow, that's a sort of interesting verb, non-depository institutions to be regulated under CRA? And the answer is no, that would change that would require a statutory change. But let's do the two rural ones. There's a question about investment into private equity funds that focus on rural or other underserved markets. Will this make it more or less attractive for a bank to invest in those funds? And someone must have said that community development activities in rural areas are especially complicated. I think Lori said they were small, but Buzz, you may have said they were complicated. You want to try both those questions, and then we'll let anybody else get a crack at them?
Sure. Rural areas often lack the kind of institutional capacity that many urban areas have, and they also lack the resources that come along with that capacity.
Can you get closer to your mic?
I'll try to speak a little louder. Is this better?
Yeah.
Great. So rural communities often lack the institutional resources and financial resources that urban communities have. And so putting together deals in rural communities is tougher. And because those activities tend to be on the small side to begin with, it's hard to make them work, make that complexity work, whereas if the deal were larger, it could accommodate more complexity.
I would like to just add real quick, we haven't talked a whole lot about this, that under the proposal, banks can fail in up to 1/2 of their assessment areas. So they could decide assessment areas where it's harder to do things. And if it is harder to do, say, community development financing in some rural communities, you could see an abandonment in those communities. And again, you know, your fixation on essential infrastructure, the large-scale interstate bridge, for example, that has a diffuse, at best, a diffuse benefit for low and moderate income people, as opposed to doing that small business incubator. And Buzz is exactly right about eliminating the regulatory criterion of economic development and revitalize and stabilize, eliminating that from the definition of community development and adding essential infrastructure. I think overall is very destructive, and actually I think will hurt rural communities. Because you can actually revitalize and stabilize rural communities by, say, putting in a sewer line for a rural community that's predominantly low and moderate income.
So we're getting to the very end, and I hesitate to do this because it's really going to require each of you to be very succinct. But we got an interesting question from one of our former colleagues who's now in Chicago. To Mark's point of not equating dollars with impact, can the panelists speak to other types of measures or metrics that would measure impact more directly, while also providing certainty to lenders and communities about what counts? Okay, you've each got like 30 seconds, so you probably are only going to want to come up with one metric, not 6. Buzz, you look like you're ready to go, and unmute yourself.
So 2 quick points. One is there's a big difference between being clear about what activities count, bright line, yes or no, and trying to figure out how much they should count, how impactful they are for communities. Those are 2 different matters. I think the latter requires more judgment. The former can be more cut and dried. In terms of building this better into the overall structure, a separate community development test that was fully rated, could be rated anything from outstanding to satisfactory to less than satisfactory, and that also incorporates these qualitative factors more explicitly in terms of their responsiveness to local needs, would go a long way to correcting the problem.
Krista, do you have some thoughts on this?
I do. Let me make sure I'm off mute.
You are?
And I am. Yeah, I think the one thing I'm sort of surprised it hasn't come up in our discussion so far is this notion of performance context. That has been something that came up in ABA's member conversations over and over and over again, that we cannot lose that as it relates to identifying specific community needs, making sure that the regulators take into account what the opportunities, particularly on the community development side, are in a bank's particular assessment areas. So it's just really important that as we talk about finding objective ways to measure CRA performance, that we not lose sight of that performance context and how that fits into responsiveness.
Quickly, any of the others?
Yeah, so let me just, so sort of thinking about this in terms of the number of loans as well as the dollar volume of loans, I think is very, very useful. That way you do a much better job of counting smaller balance loans. I mean, that's just sort of a very simple change.
So
This may be a little bit of heresy.
Go after Mark.
I'm sorry, Josh, go ahead.
Go ahead.
No.
No, go ahead, Mark. Quickly.
No,
Yeah, go
this may
after
be
you,
a little bit of heresy, given where the NPR seems to be. But you know, having examiners have a little bit of judgment seems to be useful. Having community input seems to be a little bit useful here. Getting that right balance, I agree, can be hard, but not having any of that just means you're just, again, measuring dollars, and dollars doesn't measure impact in and of themselves.
Finally, Josh.
Well, first of all, thank you so much for having this important forum. Second of all, I think if all of us were in a room, we could do a much better job negotiating a final rule than the proposal that's out there. I appreciate the thoughtfulness of my colleagues. Third of all, the criteria of innovative and flexible on the lending test, investment test, and service test would address the issue of impact, how many jobs it created, whether it really stabilizes the community, like forbearance would stabilize a community instead of getting massive amounts of foreclosure. And lastly, on a note, a sort of a personal note, I'm 56 years old. I've been doing this work for 25 years. The reason and so have many of you, and the reason why we do this is we care about low and moderate income communities. And if this proposal is finalized significantly in its proposed form, I will not only be extremely disappointed, I would ask the regulators to go out and walk in low and moderate income communities, including those around National Stadium, and assess what do they need. Do they need the big dollar deals, or do they need home loans, small business loans at the original purpose of CRA? And look yourself in the mirror and say, is this going to really help low and moderate income communities? Thank you.
So let me just, first of all, thank all of the panelists and all of the people who tuned in. I do think that while we've got some differences, you're all aligned on a number of really important points. First, the changes need to be well thought out and durable, taking into consideration interaction among them and how they'll work in practice. Second, that without a good deal more information, neither the public nor the regulators can actually figure out what the impact of this will be. Third, we can fix what needs to be fixed, greater certainty and transparency, dealing with CRA hotspots and deserts, responding to internet banking without jettisoning the entire system. And finally, this really is not the time to totally change a system that serves the most vulnerable people in communities, if not perfectly, at least reasonably well. And this has been a wonderful experience, a wonderful panel. Thank you all. I do hope that the people who listened in learned a lot and understand more about this whole issue now. And again, there will be a video tape of this up on the Urban website, and more information can be found at www.urban.org/events. Thank you all. Bye-bye.
Thank you, Ellen, and the Urban Institute.
Thank you, Ellen.
Bye.